Buying a house in Canada keeps getting more difficult, and it feels nearly impossible for anyone under 35. Luckily, we do have some investment accounts that make things a little bit easier, like the TFSA, the RRSP, and the FHSA. I like to call them the big three. And in today's video, I'm going to be breaking down the FHSA, the First Home Savings Account. I'm going to explain how it works, how to use it to the best of your advantage, the contribution rules, and how to make withdrawals so that you don't end up paying taxes if you do it the wrong way. Let's get into it. The beauty of the FHSA is that it combines two of the benefits of the TFSA and the RRSP. Similar to the RRSP, any contributions that you make into your FHSA reduces your taxable income. So for example, if you earn $70,000 in the year and you contribute $5,000 into your FHSA, your taxable income for that year is now $65,000. And similar to the TFSA, any growth within the account is completely tax-free, and when you withdraw, it is tax-free with one rule: if you are a first-time home buyer. And I'm going to explain that term a little bit further, because first-time home buyer can be a little bit misleading in Canada. So a first-time home buyer for this purposes actually means in the last 4 calendar years, you did not own a home and live in it as your primary residence. That is it. If in the last 4 calendar years, you did not own a home and live in it as your primary residence, then you're good. You are therefore a first-time home buyer. To open up an FHSA, you need to check certain criteria. One, you need to be between the ages of 18 to 71, and you must be a Canadian resident. And lastly, of course, as mentioned, you got to be a first-time home buyer. Once you check those boxes and you open up an FHSA, you can contribute, and here are the contribution rules for the First Home Savings Account. With the FHSA, you can contribute up to $8,000 per year, with a lifetime maximum of $40,000. Keep in mind, the FHSA actually gives you a benefit of catching up on missed contributions. So for example, let's say you open up your FHSA 2024 and you contribute $8,000. In 2025, you contribute another $8,000, but then in 2026, you don't put any money in. In 2027, you are now allowed to put in $16,000. So it allows you to catch up for that missed year. However, the maximum that you are allowed in any given year is $16,000. I'm going to explain that a little bit further. So same example. Let's say 2024, open up your FHSA, you contribute $8,000. And this time in 2025, and 2026, you do not contribute $1. In 2027, your maximum still remains $16,000. That is because the maximum in any given year, including your catch-up, will never exceed $16,000. So just keep that in mind, okay? With the FHSA, you can invest in a number of things similar to the TFSA. You can invest in stocks, GICs, ETFs, bonds, REITs, or keep it in cash savings as you prefer to do with your money. To take money out of your FHSA, there are certain things that you need to know so that you don't get in any CRA tax troubles, all right? First things first, you want to be familiar with Form RC-725. This is the form that you are going to provide to your FHSA provider when you are making your withdrawal. So be it Wealthsimple, Questrade, TD, RBC, wherever your FHSA is held, you want to fill out this form and provide it to them when you're withdrawing the money. Number 2, again, you got to be a first-time home buyer when you are withdrawing these funds to buy a home. Number 3, you must have a written agreement to buy or build a qualifying home by October 1st of the following calendar year. And number 4, the home needs to be in Canada and be your principal residence within 1 year of purchasing it. Here's a little catch with the FHSA though. You have to use the funds within 15 years of opening the account, okay? If you don't use the money to buy a home within 15 years, you have 2 options. Number 2 is the better one, in my opinion. But number 1 is you withdraw the money as cash and you are going to be taxed on it and it's going to be added to your income taxes for the year. Number 2, you can transfer it over to your RRSP or RIF, depending on your age, and it is done cleanly, no taxes, and doesn't affect your RRSP contribution room. To open up an FHSA, you can do that directly online with a brokerage, or you can do it at a bank branch as you prefer. There are several options with this: Wealthsimple, Questrade, RBC Direct Investing, TD Easy Trade, as you prefer. So to recap, the FHSA First Home Savings Account is a beautiful asset when saving for your first home purchase in Canada. Also, don't forget what the definition of a first-time home buyer is for the sake of buying a house in Canada. All right, 4 years owning, living, as explained before. There is an annual contribution limit and a lifetime contribution limit with some catch-up room allowed to a limit of $16,000, okay? You have to use the funds within 15 years of opening the account, or you can transfer it to the RRSP to avoid any taxes on the withdrawal. And that is all for the FHSA First Home Savings Account. If you would like to learn more about investment accounts in Canada, I've built together a guide detailing the 8 most commonly used investment accounts in Canada using experience from my time as a wealth manager for $1 billion portfolio. You can purchase it in the link in the description, and here as well is a nice little discount code for you to save some dollars on that. And now you have yourself a wonderful day. Cheers.